Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back, episode 122 of Carson's Facts versus Feelings. Sonu, we got some bad news. The Eagles won.
I was just going to say, speaking of things that scare us.
Oh, my goodness. Can you believe it? Can you believe it? But this is besides tariffs. What scares us? What we're talking. So we'll just jump right in. I mean, I playfully mentioned last week that historically when the NFC wins the Super Bowl, this is a Super Bowl indicator. Do not invest in this. It's playful. But the stock market's up like 10% on average. Higher a good deal of time when the NFC wins. When the AFC wins, like 8% on average. Not up quite as much. But here's the thing that worries us, Sonu. When the the last time Philly won a Super Bowl was 2018. That was one of the worst years of that decade, by the way.
And guess what else we had in 2018?
Tariffs, a trade war.
Trade war.
Thanks, Philly. So anyway, so here we go. This went about as viral as anything I've ever done in my career. So this tells you what I'm worth, apparently, because this is what people were talking about. I had so many people say, "Oh my goodness, I saw this note that you did on Philadelphia," like everywhere. So hopefully one of these days.
It came on my Bloomberg yesterday morning.
Yes.
Monday morning, the first thing I say, I'm looking at my regular Bloomberg morning email, and at the end, Super Bowl. And I'm like, oh yeah. Like if they don't cite Ryan Detrick, I'm going to have words with them. But they literally cited you. So I was like, okay, perfect.
One of these days, I hope to do something that's legit that people listen to. But anyway, 1910.
Be here.
Yeah, well, that's true. 1910, the Athletics, they were called Athletics back then, won a World Series. There was a pandemic of 1910, 1911, 25% bear market. 1911. Again, was part of that bear market, but all 12 months in a recession. 1913, another recession, and World War I was literally right around the corner. 1929, pretty sure you remember the stock market crash of 29. That was Athletics won another World Series. Athletics won another one in 30. The Great Depression was really ripping the economy back then. Then you went 50 years before the city of brotherly love did anything again. 1980, the Phillies now. I believe my boy Pete Rose is on that team, I'm pretty sure, from Cincinnati. Double dip recession in the early 80s. Terrible time for investors. In 2008, the Phillies won another World Series. Remember that. 2018, the Eagles won a Super Bowl, like we just said. Trade wars, a pretty rough year for the stock market, a near bear market during that year. And now we can add 2025 to the list of either a City of Brotherly Love Super Bowl or World Series. Sonu, should we hide under a table?
I don't know. I was trying to think back to, obviously the Super Bowl is up, sports in the air. Mm-hmm. But this is the season, I'm a fan of Formula One. And Netflix does all these series now with sports. I feel like that's the biggest thing ever since, what was it, The Last Dance? And during the pandemic, everyone was really into it. And since then, we've got, a dime a dozen of these. I was just watching something about India-Pakistan, the great rivalry. Cricket, right? So my earliest sporting memory ages ago, about 25 years ago or so, was when Pakistan toured India for cricket matches. And they hadn't done that in 15 years because of the war and all of that. So they came and, we went to the state. It was literally like they were soldiers with AK-47s and things like that all over the stadium, right? Because it was so dicey. But everyone is so pumped up. It was a really close game. And this is in South India. And what happened was that people thought, Indians don't react well to losing games, especially against Pakistan. Yeah. So we were like bracing. Oh my God, it was a close game. We lost, but the whole stadium stood up and cheered for the Pakistani team, which was amazing to see. So that's like my earliest, most vivid, sporting memory there. Just, off a tangent. But if you are, looking for something to watch on Netflix, I recommend that. The Greatest Rivalry, India versus Pakistan, cricket.
Interesting. No, that's good. I think my earliest...
You don't have to watch a 5-day cricket game, by the way. So they've done it pretty well.
My earliest is probably watching the Bengals lose a Super Bowl in 1988 and breaking my heart ever since. But we'll move forward. Yes. So again, so that's obviously playful, but we wanted to clearly we've been optimistic. We've been bullish. We feel like a broken record. We're still in a bull market, right? We still see positives. But this week's podcast, we wanted to talk about some of the potential worries, some things that scare us. I mean, scare is a strong word. I want to be very clear. We know tariffs are there. We're not going to spend spend all that much time on tariffs because tariffs are there. The uncertainty is there. I mean, maybe let's put it this way, Sonu. Maybe let's wrap up a tariff discussion in 5 minutes and then get to the stuff that other things. What's the latest with the 25% on steel companies or steel imports? Where do things stand on the tariffs? And again, let's just spend 5 minutes on this.
Yeah, so those have, I think, got into place. I mean, a tariff man struck again over the weekend, right? Second weekend in a row. So there's a lot of uncertainty with respect to that. Whether, he'll give exemptions, right? Today I read a headline saying the Australian PM, the Prime Minister, was like, oh, we may get an exception. Like, does everyone just call the White House and ask for an exception? Like, what is going on here? Right?
How about that?
But there's a risk here, right? Europe is, so this is the thing. I was on, Behind the Markets, Jeremy Schwartz's podcast, and we were talking about Europe. And Europe is very interesting because, we're seeing a lot of the economy is not doing great, but a lot of stock market indices in Europe are doing really well. I'm sure you've seen it.
Yeah,
exactly, right? And so that's there. But the backdrop of tariffs is Europe's already preparing retaliatory tariffs, especially because of the steel and aluminum tariffs are across the board, right? That's what the U.S. is saying. 25% tariffs on all steel and aluminum imports. Problem is with Europe, Trump can't just pick up the phone and talk to someone. Like with Canada, he can talk to someone. Mexico, he can. India, he can. China, maybe, if they're ready to talk to each other, right?
Yeah.
But Europe, who do you talk to? It's like talking to a committee. You and I know how well decisions get made in a committee. And so it's, I think that's where the problem will come, right? Because Europe's not a small entity, by the way. It is the, third largest economic entity after the US and China. And we buy a lot of stuff from them. We sell a lot of stuff to them as well. So there's a lot of intertwined relationships. The other thing I think that's going on is the Russia-Ukraine war. There have been noises that if that ends, hey, guess who benefits? Europe benefits. Yeah. And I think there's some of that in play with European stock indices. I know you're going to talk about tariffs, but all of this is playing together, right? All of this uncertainty, like what's happening with tariffs? How will the Europeans retaliate, right? And how, what sort of negotiations will even happen between the U.S. and Europe? Like I said, with U.S. and Canada, U.S. and Mexico, I think it's fairly straightforward. I think there's still a lot of questions, but even the U.S. and China, for that matter, right? And the other thing with tariffs, Ryan, remember I talked about de minimis goods? We talked about it last time. They did away with that. Like no tariffs on de minimis goods. So if you're sending a package from China below $800, that's no longer going to be tariff, right? Last week, the fear is, that will be tariffs. That's going to be a blow to, that's one way China got around the tariffs, in 2018, 2019, by splitting up the packages into smaller packages and then avoiding the tariffs. And, by putting tariffs on de minimis goods, the Trump administration is probably like, okay, you can't do that anymore. But they did away with that. And so the Chinese are probably happy.
No, interesting. I mean, you think about Europe here. You've got Poland flirting with all-time highs. Greece is way up there. Germany's way up there. I mean, the stock 600. I know the financials in Europe are breaking out to new highs. I mean, there's some positive things happening. I think at the end of the day, it's just a bull market, right? I mean, this is a bull market. We've been talking about this. Yeah, other parts of the world have lagged now for the first start of this year. Some other parts have been doing a little better in the U.S. We think when all is said and done, the U.S. will still be the big cog of growth and probably outperform majority parts of the world. But there really are some interesting things taking place there. So, that's tariffs. I'll start with something that caught my attention, right? Again, we're talking about things that scare us, things we're looking at that, aren't going to change our bullish views, but they have our attention. So there's something called the December low indicator. Simply put, Sonu, when the S&P closes below the closing low in December, but during the first quarter, so in the first quarter, it violates the December low, that's potentially a warning sign. Now, here you go. And that just happened, by the way, earlier. I think it was on January 10th. That actually happened, where that was the closing low so far this year. It was below the low in December. Previous years, we're about to 1950, when you stay above the December lows. So we didn't do that this time, but when you have, it's been happened 38 times. The full year's up like 19% average. The full year's higher 95% of the time. All right. The last 2 years it happened. We talked about it then. We talked about before. Pretty solid. But when you break, like we did, full year's down on average, just barely, but down 20 bips. So you're up 19 in one and you're virtually flat the other. Pretty wide dispersion. Higher only 49% of the time. It's happened 37 times. I mean, that's
Wow.
pretty incredible. And some of the years that this has happened, let me just make sure I have. Yeah,
is 2018 in there?
Yeah. So we've got 1973, 1974 were terrible. 81 was really bad. We had let me get here. Yeah, the tech bubble, 2000, 2001, 2002. This happened in all of those. And then in more recent times, 2008 was a major warning sign, obviously. 2018, sound familiar? That was in there. And then 2022, and this is the big one, because 2022, early in the year, things were okay. But we did violate that, right, in March when we had that big sell-off because the war started in March. Then the market did bounce back pretty nicely in the summer of 22, and then everything fell apart in the fall of 22. You could argue it was a warning sign. Now, trust me, there's a lot of years where things were positive. We still think this year is going to be positive. But I'm just saying that this is one thing that clearly has caught my attention, the fact we violated. But it was like for a cup of coffee, like you're drinking there, like a cup of coffee, we violated those lows. We popped above it. So, still, it's out there. The December low indicator, go to carsongroup.com/research. It'll be blog on this potential worry that I have right now. Sonu,
why do you think?
Yeah, go ahead.
Why do you think that is? I'm curious.
Yeah, usually the first quarter is pretty strong. I mean, I think it's as simple as usually first quarter is pretty strong,
and especially January too, right?
January's pretty, and this year what? I mean, we talked last week. Okay, well, so goes January. If the first 5 days are strong, we talked about those. You can go back and read them and listen. So those are still outweighing this. We'll be very clear. But it's like something was a little off. And honestly, the other thing, I mean, let's be clear. December, what happened in the stock market in December? It was down this year.
Yeah.
Okay, usually December's up a lot, so you got an easier base where you're starting. We were down in December, so I didn't look at that, but I'm going to take a wild guess. A lot of those years probably had weak Decembers, which isn't normal. December's usually like the highest month, not the best month percentage returns, but in terms of most likely to be higher, December is right there. So those things happen, but again, we still gained 23% last year on the S&P. That's price return, maybe 25% or so total return. Still a good year. Maybe we just gave up some gains in December as the Fed was a little more hawkish. We talked about all that stuff before, but I think that's probably one reason. What's something else that's caught your attention? Maybe not along the lines of tariffs, but something else that you're kind of watching that worries you a little bit here.
I'm going to pick that same date you mentioned. Did you mention January 10th?
Yeah, you know what? It's the day my brother passed away too, so that's a very easy day to remember in my brain. So yes, a lot happened on January 10th. So yeah,
and January 10th was when we got it's interesting, the low.
And Ohio State beat Texas that night. I'm just going to say Jack Sawyer with the fumble. Yes. That ball bounced up right at Jack Sawyer. He ran back. I said that was my brother. My brother patted that ball to jump right back at Jack Sawyer for the 83-yard touchdown to beat Texas. So
that's a great memory.
Thanks, Aaron. That was nice. Yeah.
We'll talk about the January payroll report, which just came out in last Friday. But January 10th was when we got the December payroll report. I don't know if you had a look.
It was a Friday. I know that much. I know it was a Friday. So yeah.
No, it was a very positive payroll report. And what happened? Yields jumped because suddenly it was the good news is bad news. Everyone is like, oh, this is too strong. The labor market is too strong. Growth is going gangbusters because the labor market is going gangbusters. And maybe the Fed's not going to cut. The probability of no cuts at all in 2025 on that day rose to 31%, right? Which is the highest we've seen in a while. And 31% is pretty high. I mean, the base case is still cuts, 70% odds of a cut. So it's still, base case is like markets predicting cuts, right? So this is back in a month ago, literally, right? So January 10th. And since then, the odds of cuts in 2025 actually increased. Right now, I think the probability of no cuts in 2025 is about 15%, right? It in between, it fell to below close to 5% or so. But the market rallied after that, right? And that gets to the other part of the uncertainty here, right? Like what else worries us? And it's kind of related to tariffs. Remember, January 10th, I don't think any of us were thinking about tariffs per se. We kind of knew it's coming at some point. Maybe you thought it would be February or March. We didn't think it would be within the first week of the administration coming into office. But still, at that point, it was more about just the Fed and the labor market and inflation. So I think one worry is the Fed. I mean, with this tariff uncertainty, if we get a inflation number, say this week we're getting inflation numbers, or even in March or April when we get there, if it's slightly on the harder side, I think that just prolongs the date when the Fed starts to cut again. Right now, I think markets are pricing in the first rate cut in June. I think, honestly, like 3 or 4 months ago, I would have thought maybe March or May. Now I don't think that, right? And at this point, I'm like, maybe the first cut, Ryan, won't come before July, right? But until we have some clarity on that, I think the market's going to be like, will they or won't they? I think that's a big driver here. And I think the tariffs, we talked about it, tariffs play into that, right? That uncertainty. Who knows what the inflationary impact of tariffs will be? And we may not know for a long time. It may be months, right, before we know. And that's assuming the tariffs actually put into place.
Sure.
People don't get exemptions, things like that, right? So it's so much uncertainty there. But I think where we don't have, where we have little more clarity, ironically, is that we probably know that the Fed is going to sit on their hands for a while if this continues. So that's something that worries me. And during that time, I mean, it may be okay. Chances are it will be okay, even if they sit on their hands, even if they get the first rate cut in July. Or let's take that extreme example. Say we don't get rate cuts at all this year.
Okay.
Do I think we'll be in a recession? No, I don't. But the odds of something breaking increase. If that makes sense.
No, it does. Well said there. That's stuff to clearly look at. On the YouTube channel, we are sharing more images now. Sonu just talked about some things there. We'll share those, get those to Drew. Our producer helps us with all these things. And then I shared the December low indicator stats as well when I was talking about that. Interesting stuff there. So, something else, Sonu, that's caught me. I believe we talked last week about this, but February is the worst month on average in a post-election year. And honestly, first quarter of a post-election year is one of the weakest quarters out of all 16 quarters of a 4-year presidential cycle. So we're kind of just in the time frame when some choppiness makes sense. Maybe it's because you get a new president and there's, or even an existing president, but it's their first term, or they just start to do some more unpopular things. The honeymoon season's over, as you've said before. You're talking about some issues potentially with the Fed not cutting or maybe not being as likely to cut early in the year. Maybe that's why the first half of this year can be a little choppy, a little frustrating. I don't think that'd be all that bad after getting 25 or 20% 2 years in a row. Yeah, we chop around a little bit. You know what? Okay, and then look around the globe. Other parts of the globe are doing well. So hey, you have a diversified portfolio. Maybe we don't have a ton of emerging market exposure. We don't have a ton of developed international exposure. We still in the U.S. do better and all said and done, but we have some. Hopefully, all the listeners out there. Yeah, it's not zero. Hopefully, all the listeners. You have a little bit of gold. You have some bonds. There's still some reasons to keep that diversified portfolio that can do pretty well, all things considered. So those are things I like. One other thing gets me. We'll share it on YouTube right now. The advanced decline lines. Okay, what's an advanced decline line? A cumulative basis, how many stocks go up versus down. You can look at the S&P 500. You can look at the Dow, small caps, mid caps, NYSE. Okay, we've got flirting with new highs on the major indices. Yes. But various advanced decline lines, Sonu, have not broken out above their previous peaks. Now, this is, I call it a caution sign, a yellow. It's not like a major sell signal. I think eventually we'll get that. The way I learned it many years ago, breadth leads price. If you see advanced decline lines breaking out, that tells you a lot of stocks are going up. What people remember now, in the late 90s, advanced decline lines are going down for years. Okay. And why was that? Because only tech was going up. Right. It was only tech was, now the market was going up.
Hey, how many years did that run for? Do you remember?
Almost 3. Curious. I mean, late 98, 99. Okay. So a year and a half, I guess, into 2000, everything kind of spiraled out of control. 2000.
So about 2.5 years.
Yeah. It went a while. And then you can go back in 2006, 2007. We saw some similar things, market making new highs, but breadth not confirming it. So anyway, these gives you big warning signs that might take a while to get to. Okay, so this is again a yellow. I think we're going to get advanced decline lines breaking out. When they do, we'll talk about it. But again, that's just something that's caught my attention, that we have new highs and flirting new highs, not as many advanced decline lines participating. But then I see, year to date, 10 of 11 sectors higher, only technology is lower. You look around the globe, just about every stock market in the globe is higher. I'm sure there's one that's negative, but most stock markets. So our friend JC Peretz is like, listen, this is market breadth, because all these different sectors and all these different groups and all these different stock markets around the globe are breaking out to new highs.
What's interesting is one of the more prominent markets that's sort of like breaking down in a way.
Okay, yep.
Which has been doing well over the last few years, India.
Oh.
And the Indian stock market is going the other way recently. I mean, I think part of it has to do with currency too.
Yeah. Okay.
So, and then tariffs, right?
It's not because of the cricket team, right? It's not because of the cricket team, is it?
Yeah. They did lose recently. They got lost in a bad way.
That's what I'm saying.
Bad
I
way.
know. Yeah, I know. Yeah.
Everyone's upset. There's no productivity there.
Exactly. Everyone's just in a slump. Yeah.
Exactly. So that's, curious. That's interesting. Like the one market that's done well, which is not to say these things mean revert or anything like that, but yeah, like I said, it's just interesting. I mean, and going back to the tariff point, India is an interesting case where, in addition to tariffs on steel and aluminum, Trump announced retaliatory tariffs, right? What does that mean? They say, look, if you put a 20% tariff on our goods and we are putting only 5% on your goods, we're going to increase that 5 to 20. We're going to match it.
Okay.
Right? So now a lot of developed markets, including Europe and a lot of other countries like Korea and Canada and Mexico too, for that matter, they don't have these big tariffs for US goods because we have free trade agreements with them. So it's like free flow of goods, right? Without being tariffed and things like that. But with countries like India, the problem is India puts these tariffs on to protect their own markets. And the US is like, wait a minute, we're going to increase tariffs. But the US has a lot of other, what we call non-tariff protectionism measures that other countries don't do, whether it's like farm subsidies, right? Anti-dumping measures, Buy American rules, shipping rules. I mean, I won't go into the Jones Act, but that's an example of that. So if you combine all of these non-tariff measures with tariffs, right, and then when countries like India get onto the negotiating table with the US, India's like, wait a minute, yeah, your tariffs may be low, but you're doing all this other stuff too. With us, we're not doing this other stuff. We just have 20% tariffs, right, or whatever that number is. And that's why negotiations usually break down between the US and countries like India. So, but India is an ally. I think the prime minister is in, probably meeting in Europe right now with JD Vance. So I saw a picture of them together. But anyway, all this to say there's some uncertainty there too. I think that's could possibly why the Indian market is a little jittery about, what's coming with tariffs and things like that.
Okay.
But China's doing well. I mean, the Chinese don't seem very worried.
No, that's a good point. I mean, China's stock market has been strong, but we've seen this before. We've seen these fits and starts out of China before. And Lucy and the football. One other one that's good stuff there. One other one that gets me. It's year 3 of the bull market. We talked about this in our outlook, so some of this might sound familiar. Usually, years 1 and 2 of a bull market are strong. Sound familiar? We saw a lot of gains. Actually, year 1 of this bull market wasn't all that great, but year 2 really caught up in a big way. In year 3, Sonu, the years that made it to year 3, this is going back to what I go back to here. Looks like 1949. That bull market started in September 49. So multiple bull markets since then. Year 3 is up only about 2% on average. Quite choppy, quite frustrating. Some of them don't quite make it even to year 3. So that's something to remember. So if they make it to year 3, you're talking only 2% on average. And again, that's after big time double-digit returns years 1 and 2. Now, the good news to this, we think this bull market will get past year 3. We think we're going to have better returns than 2% as we've laid out here, probably low double-digit returns, what we're looking for. At the same time, once you get to years 4 and 5 and 6, it gets better again. It's almost like you need to just catch your breath. Sideways consolidation, that's okay, although we think it's going to be a little better than that. So again, that's just another potential worry that's out there that is in the back of our head that we're paying attention to. But again, that's probably why you have a diversified portvalue. Maybe small caps and mid caps do better.
You can't sprint a marathon. Well, unless you're from Kenya, I suppose.
That's true. That's true. Value does better. It's not as big as the growth stocks. I mean, we've seen the growth stocks. And one other worry of mine, I guess, is the reaction we've seen from some of the large cap tech names, right? The Mag 7. I forget who coined them the Lag 7. So whoever it was, I give you credit. That's kind of funny. But we have seen that. It's been a little bit of Lag 7. Yeah, they're making a ton of money. Yet at the same time, how'd Amazon do? How'd Tesla do? How'd a lot of them do? I think it's Meta, I guess Facebook Meta, up, I believe it's 13 or 14 days in a row the time we're recording this. So it's like the most out of any of those 7 stocks that have ever been up that far or that many days in a row. But the other 6, they're struggling a little bit. Now, we're more neutral tech. We've said this before. Doesn't mean we don't like it. We've got exposure. But, hey, maybe that could pull or kind of put a cap on the market a little bit when your largest part is struggling. But then under the surface, a lot of other things are doing well. What do you want to add to that, Sonu?
No, I think we talked about this earlier this year. But look, last year...
Who knows? We've talked about everything, I think. So exactly. Might as well do it again. Yeah.
Last year, the market, the S&P 500 is up 25%.
Yep.
15 percentage points came from the Mag 7.
Okay.
Which is great by itself. But remember, the market was up 25, right? And you'll take 25 above 15. The remaining 493 stocks contributed 10 percentage points. That's not for nothing, right? And pretty good year. Like I said, I'll take 25 over 15, right? And we may see that split more in favor of the remaining 493 this time around, as opposed to what we saw in 2024, let alone even 2023, that, the Mag 7 was an even larger contributor, right, to the overall 26% return.
Right,
so,
right.
Just something to keep in mind. But, something you said, that what you said about the advanced decline lines were interesting. Now I'm thinking about that. I can't pretend I'll go off charting, but I'll leave that to you.
Yeah, I think it all just kind of makes sense. It's, again, a little bit of a worry out there. What? I mean, I've got like another one or two, but what other things are you watching?
Should we talk
Sony?
payrolls?
Yeah. Okay,
we
let's
got
do
payrolls
that.
because
On
there was
Friday.
some,
Yep.
Overall picture, it's still solid. I think our friend Guy Berger over at Burning Glass Institute says it well. Look, if you have a job, the job market's good, right? Because you're getting fairly solid wage growth, salary growth, things like that.
Mm-hmm.
Now, if you don't have a job or if you're looking for a new job, it's quite tough. It's much tougher. It's definitely tougher than it has been last year. It was much tougher than it was 2 years ago when everyone is like switching jobs, things like that. And I think there was more power with workers as opposed to employers. This time, now it's the other way around, right?
Yep.
So January payrolls was always going to be hard to figure out because January is when we get a lot of revisions.
Right.
Plus, we had weather issues. We had big snowstorms in the south. Remember Atlanta and Dallas, and that was right during the middle of Jan when data collection for these payrolls takes place. And we had the fires in California too, right? Now, the last 2 years, January payrolls have been really strong. It's been very, too strong almost, right? Back in January 2023, 2024. So this time I was like, okay, if we get a soft number, that's not going to be great. And we did get a soft number, 143,000, expectation for 175,000.
Right.
I wouldn't have been surprised to see like 225, 250,000, to be honest. But then, like I said, we had all that weather issues and things like that. So anyway, set that aside. We also got big revisions to 2023 and 2024. Right. Again, this was actually, ironically, less bad than expected. 2024 jobs was revised down from 2.2 million to 2 million. 2023 jobs was revised down from 3 million to 2.6 million. Again, these are actually solid numbers. It's just not as gangbusters as originally thought, right? Back in 2019, the economy created just under 2 million jobs. So 2 million is not a bad number, right? The other thing is we got employment revised down, but recently GDP growth, especially over the last couple of years, was revised higher. So what does that mean? Right. Output strong, but fewer people are working, fewer hours of work. That means productivity growth is strong. So productivity numbers are going to be revised up when you get the numbers next month. So that's a positive there. I'll pause here, Ryan, if you want to.
So, we'll definitely, I mean, people probably know productivity being stronger in our country has been a big theme of ours. We've had for well over a year now, maybe a year and a half, almost 2 years, and this is playing into that. But I do want to point out, Sonu, because, this is down the rabbit hole, and I just want to hear your opinion. Excuse me, I get all choked up here. Oh, excuse me. I get choked up when I talk conspiracy theories. So we lost 600,000 jobs, okay? Just poof, just like that, from 2023 to 2024. I mean, listen, that just seems odd. Is that normal? That seems like a lot of jobs that just poof went away. Now, you know where it's going. It's election year. Election's over. I don't know. I'm not a big conspiracy person, but every year it seems like we get these revisions. How can we not be more accurate? I mean, 600,000 jobs is a lot of jobs that just didn't happen.
Yeah, and actually, it turns out that was actually better than expected because the BLS actually...
there you go. Way to go, economists. You did better than we thought. You only missed it by 600,000. Way to go.
The Bureau of Labor Statistics actually told us, I think it was back in September, October, that it's going to be revised down by something like 800,000 jobs.
Right.
Not 600,000, right?
Okay.
So, but... it actually ended up being 600. No, there's no, there are always revisions when you go back and see that you get a more accurate count, and there's a fine balance there, right? All of us want the numbers immediately, but that means there's some quality issues with those numbers. So that's why sometimes I always talk about take a 3-month average, right? Yeah. Don't just rely on the 1 month number, right? And then look at the totality of data. So that's why that avoids some of the noise that comes about with payroll. We know these are going to be revised. I mean, a lot of times it's not like it's always revised down. It could be revised up too, right? So, and like I said, at the end of the day, 2023 jobs, yes, it was revised down to 2.6 million, but that's pretty good. Yeah. That's pretty solid. 2024 revised down to 2 million. That's pretty good too. And like I said, there is that productivity story at the same time. But again, look at the totality of data. These are times when you want to focus on the ratios. Like unemployment rate, because there the numerator gets revised, but the denominator also gets revised, right? So then you have some control there. You're like, okay, maybe there's less change happening with something like the unemployment rate. And look where the unemployment rate right now is, 4%. It went down from 4.1 to 4%. That's the lowest since last May. That is pretty solid. That's historically low. The prime age employment population ratio is up to 80.7%. That is higher than anything we saw in the 2000s expansion, anything we saw in the 2010s expansion. Tells you that most people who want to work are working. And that's the other side of it, right? When I think about, okay, maybe hiring is low, but maybe that's because there aren't enough workers on the sidelines to hire. I'm not saying there aren't people unemployed and things like that. And look, we'll never get to 100% prime age employment population ratio, right? Even in the 90s, when we had a amazing labor market, it was like 81%, 81.5%. So we haven't gone above that. That is the threshold, probably as high as we can go. We're not far below that, which means there aren't too many workers. And if we don't get more workers coming in from outside the country, less immigration, which seems likely. That's going to imply, okay, hiring is going to be less than what we probably expect.
No, good points there. I mean, there's some good and some bad, I guess, is what we'll say with this recent labor market. One thing that you pointed out, you do a daily note for our more than 500 Carson partners in 42 states, and it's always very detailed and excellent. One thing that you pointed out before,
I didn't know about the 42 states.
I hope
like,
it's
that's
right.
Interesting.
I hope that's the right number, Sonu. Don't get me in trouble. Pretty sure it's the last number I heard. We're growing. We're growing. Hey, if you want to join, listen, if you're an advisor, you want to join up, carsongroup.com. We'd love to talk. Let's get that to 50 states. How's that? Let's just put it there. Let's get it to 50 states. I think I can say that comfortably.
Now I want to know the 8 states we're not in.
Ooh, I don't know.
Should find out.
Well, it's probably out there. Somebody knows it. Let's see here. What was I talking about? Oh, construction jobs. Construction jobs, according to your data, well, you said it, but the government data, 77,000 jobs created the last 6 months, up 2.5% year over year. That's pretty darn strong. You go back in history, construction jobs tend, it's kind of like an advanced decline line. Actually, it tends to kind of roll over before the trouble comes. The canary in the coal mine. Now, listen, with the higher rates, the aging economy, this is one that maybe will start to crack sometime, but it hasn't yet. You want to add much more, but I mean that's another positive to me is construction jobs are hanging in there, right?
Yeah, I think the canary in the coal mine is a good way to put it. Construction payrolls are up about 2.2% year over in January, year over year. That's down from 2.5%. 6 months ago, it was running about 3%, year and a half back. So, that's 2% is still good. It's slowing down. Now, if it gets to 0.5%, 0%, I'll start to worry, right? But there are other cyclical areas of the economy, I think, that are suffering, like manufacturing jobs. Last 6 months, fell 79,000, right? Professional and business services last 6 months fell 25,000. Tech jobs fell 10,000. And tech is, maybe all these places are getting more productive, especially technology. I mean, manufacturing losing 79,000 jobs is not great, but that gets to another part of the economy. Over the last 6 months, created about 1 million jobs, 1.1 million jobs. We'll get some revisions, but let's say about a million, right? 40% of that was from healthcare and social assistance. That's not something that is the cyclical part of the economy. That's a non-cyclical area of the economy. Government jobs, another 19-20%. By the way, this is not federal government. I know everyone's talking about federal government jobs. Yes. This is mostly state and local jobs, right? Out of the 198,000, only 22,000 were federal government jobs. And then leisure and hospitality. Yes, it's cyclical. It created another 17-18%. So, leisure and hospitality, like I said, it is cyclical, but these don't pay that much, right? What do you need to see for the, cyclical parts of the economy to accelerate? For GDP growth to go from 2 to 3%, we need manufacturing going up. We need professional business services going up. We need construction to be going up rather than down. Construction still holding solid. That's good. But again, in terms of, worries me, but this is what I'm watching, right?
No, well said. Well said. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. It helps with those algorithms. Again, this is episode 122. Besides tariffs, what scares us? So we got a couple more minutes here. The other one, I mentioned it before, and this is, again, a playful one, but hey, it scares me. There are 12 signs of the zodiac. We just had the year of the rat. Year of the snake. Apologies. Year of the snake just started. You look at all 12 signs. Year of the snake is the worst performer for the stock market.
Thank you very much.
Yeah, up less than 1% on average. Higher 50% of the time. Higher just a coin flip. So again, now the good ones. Let me go lower here. Goats, oxes, dogs, pigs, and rabbits. So those are the best years. Whereas rats,
not horses.
No, horse isn't all that great, actually. That's us. Sonu and I are horses.
Us.
Yeah, that's us. Horse, rat, rooster, and snake are some of the weakest. Again, never invest in this, nor the Super Bowl indicator. But it's interesting that, those are all kind of flashing some things that scare us.
Between an eagle and a snake, what do we need? Like, isn't there a picture of like an eagle holding a snake in its beak or something?
Hey, with AI, we can make it. We can make anything.
Oh, there you go. That's what we should have.
So Mr. Powell, I know we're almost at the end of the show. Mr. Powell goes to Washington. The semi-annual Humphrey Hawkins testimony, I believe is what it's called, is happening. I mean, obviously, we all just zoom in so much when Powell talks. Anything going to happen from that, you think, Sonu?
I just saw the headline where, in quotes, we do not need to be in a hurry.
Well, there you go. What's the market doing on that news? Hanging in there, selling off a little? I don't know. Sounds kind of like market might sell off. I don't know. Yeah.
I think the market is it's flat right now, so it rallied over time. But yeah, look, they're not going to be in a hurry to adjust interest rates. That's the story. I think he's going to be dancing around that. He's going to get a lot of questions as to, like, what are you going to do if President Trump tells you to lower interest rates? It's going to be like, he can't tell me to do that. We'll just follow what we do. And, but his job he has exactly 1 year left. And so...
I thought I saw it was May. Somewhere I thought it was May of 26.
Is it? Maybe it's May.
I thought I saw, because he started in February. He started in Feb of 2018, but I thought I saw May. But hey, send us a note. Facts versus Feelings. VS. Facts versus Feelings at carsongroup.com. Let us know, how much longer does Powell have? And will he listen to his boss, or will he tell his boss to shove it? I don't know. We'll have to stay tuned. It'll be fun. We'll talk about it. I hope he kind of tells him to shove it. That'll be kind of fun to talk about on a podcast. But
man, that will be fun for everybody. Maybe not for markets, but
well, that's true. Maybe not. But then markets, hey, we're withstanding a lot of stuff. But anyway, back to Powell. What else do you think? Anything going to happen?
No. I think he's just, like I said, he's going to be dancing around the question. Yep. Like, we're not in a hurry to reduce interest rates. But it goes back to what we started talking about, right? Where is the uncertainty now? How does the uncertainty in tariffs manifest itself? I don't think it's about inflation or anything like that. Maybe eventually. But even then, it's like a one-time price increase, right? Unless they keep ratcheting tariffs higher. Yeah. It's going to be about the Fed. Does this push the Fed to cut later than normal? At this point, I don't think he's going to say, like, we're going to cut in July instead of June. We have no idea. I don't think they have any idea as well. But what's the odds, right? What's the probabilities of that?
Oh, well said. Did you like the Super Bowl halftime show, Sonu? I have to go there. What'd you
I'm not a big rap person. See, I didn't grow up here, right? So I didn't. Two genres I haven't really gotten into, a country and rap. I don't listen to either of them because I think you kind of have to be here. You have to grow up in that. Like I grew up listening to like 80s hair bands, and then 90s grunge made it out into, in India. So that was big. And like by the, I'm glad I kind of got out by the late 90s because that's when Backstreet Boys is getting big. But
they were big.
By then I was out of there.
They were big everywhere.
Then I came here and, but no, so I never got into country or rap. So anyway, I'll just leave it there.
That's why we're friends. I think we like some of the same stuff. I have no idea what happened at that halftime. Call me old, call me whatever. I don't know. I don't get it. I don't understand it. I said, if you want to have the worst halftime ever, they should have Creed back and just see what Creed did at Thanksgiving many years ago with people flying.
What was your favorite one? I can't say I watched too many Super Bowls. I've watched fewer the ones.
So I got into this with my wife a little bit in terms of the halftime shows. I don't even like Bruno Mars that much, but I liked Bruno Mars into halftime because he brought energy. He brought songs, and you know what he also did? He brought the Red Hot Chili Peppers out. He brought other artists out. Yeah. I like that because people get, if you don't like rap, it's like, okay, what's going on here? If you don't like country, what's going on here? If you don't like it, he brought other people. I like the idea of having a Super Bowl show where you have other people. And again, when my Bengals made it a couple years ago, that's when Snoop Dogg and Eminem and all of them got up there singing songs you knew, and it was a conglomeration of different people. Personally, that's the way I would like to see it. Everyone has an opinion on this, but I did like Bruno just because he brought the energy and brought a lot of other people on stage to kind of share the spotlight, and there were songs everybody knew, which I think is important when you play a Super Bowl halftime show. Anyway,
I think my favorite was Prince. I think this was over a decade and a half ago, something like that.
That's true.
Prince that was my favorite. And amongst the ones I've seen. Like, on TV.
That one's famous for many reasons, but I guess it rained, right? And he said, no, I'm still wearing these tall stilettos that he wore. And people to this day said it was amazing he didn't trip. Like they said, or fall. They said, you're going to fall. I said, I'm not going to fall.
No,
he's Prince, so of course he didn't. But a lot of dancers and people are falling over the place. Prince didn't fall. So there you go. That's a good one, too. Anyway, we're off the rails now. But with all that, this is the latest Carson's Facts versus Feelings, episode 122. besides tariffs, what scare us? Thank you all listeners. We've got some really good downloads, listens this year. Again, give us a like, give us some comments and things. That goes a long way. We appreciate it. With all that, everybody, we'll be back next week to talk about it all again. We'll see you then. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.